Okay, thanks everyone for joining us today. So my name's Mike Coffin, and I head up the oil, gas, and mining team here at Carbon Tracker. So today, what we'd like to do is we'll be running through a webinar and on our new report that we released yesterday called Managing Peak Oil. So today we'll have a presentation by one of the co-authors of that report, Axel Dalman, who's an associate analyst here at Carbon Tracker. But before we do, we'd like to have an introduction from Eric Ling, who is the Senior Engagement Manager at Vivid Economics and who led the energy modelling for the Inevitable Policy Response Programme, the IPR programme, which develops the forecast policy scenario, which is the scenario we used in the report Managing Peak Oil. So Eric will give us a very brief overview of that scenario before Axel then talks through the report in a bit more detail. And what we'd like to do at the end of the session, so we've got 45 minutes in total, is to leave a decent amount of time for questions from the audience. So please do put the questions into the Q&A box as we go through, and then we'll look to have a discussion on those following Axel's presentation. So Eric, if I could pass over to you now, that would be great. Thank you.
Sure thing. Thank you, Mike, and sorry for those technical difficulties. So I'll give a very quick introduction to IPR and the forecast policy scenario. So IPR is a leading energy and climate scenario commissioned by Principles for Responsible Investment and supported by world-class research partners. So PRI commissioned IPR in 2018 to advance industry's knowledge of climate transition risk and to support investors' efforts to incorporate climate risk into their portfolios. IPR is led by Vivid Economics and Energy Transition Advisors, but has a broader research consortium, including Planet Tracker, Quinn Brook Infrastructure Partners, 2 Degrees Investing Initiative, Carbon Tracker, and Climate Bonds. More recently, IPR has been supported by a range of leading financial institutions. BlackRock, Fitch Ratings, Nuveen, Robeco, BNP Paribas, Goldman Sachs Asset Management, and New Forests, and also has core philanthropic support from the Gordon and Betty Moore Foundation, the Finance Hub, and Climate Works. What IPR seeks to do is give investors a clear forecast for how climate policy and how policymakers are likely to drive change in the energy and land system in order to meet climate targets, and how that change is likely to affect the value of financial assets, and therefore draw out implications for investors. There are 2 scenarios in IPR. They're both underpinned by a policy forecast. The forecast policy scenario is the core scenario, where IPR forecasts the most likely policies and assesses the impact on those policies across the energy sectors going forward. There is also a 1.5 degree required policy scenario. This is less of a forecast, and this is more an analysis of the gap between what we forecast and what is needed to achieve 1.5 degrees. So those two scenarios, the IPR forecast policy scenario, which is our central expectation, and the 1.5 degrees C required policy scenario, which is what is needed to achieve 1.5 degrees. Those 2 scenarios are kind of at the core of IPR. The central thesis of IPR is that climate policy is accelerating, and policymakers are increasingly, we are approaching a tipping point in which policymakers will increasingly need to act rapidly and act aggressively. The logic for that tipping point, there are several kind of strands of drivers for that tipping point. There are improvements in climate-friendly technologies. There's increasing recognition of the economic damages that climate change will have. We're seeing greater kind of weather-related stress events, and even financial regulators are starting to take note and put pressure on policymakers to head off some of the worst aspects of climate change. Coupled with that is the Paris alignment process, where countries are due to submit a 3rd round of climate pledges around 2025, And prior to that, there will be a global stocktake where announced pledges are analyzed and compared with what is needed to meet the objectives of Paris, and policymakers will be asked to come back with more aggressive and more Paris aligned commitments. So that package of drivers, the Paris process driving greater commitments from policymakers, and the whole range of underlying drivers for more rapid policy action, is what is at the core of the IPR scenario, and the tipping point and step change in climate ambition that we forecast to occur around 2025. IPR is geared around 8 key policies, which we think policymakers will focus on as they ramp up ambition. So there's carbon pricing, there's phasing out coal, both in terms of ending the build of new coal, but also ultimately phasing out all coal-fired power. The shifting to 100% clean power in electricity systems, where the UK has a target for 2035 for 100% clean power, and we think other countries will follow suit. The shift to zero emission vehicles for cars, but also trucks. Shift to low carbon buildings with greater use of electrified heat. A transformation of industry towards 100% clean industry and clean steel, cement, and chemicals. Low emissions agriculture with a range of measures to reduce the greenhouse gas impact of agriculture, and a set of policies around forestry, chiefly ending deforestation, and for countries that have ended deforestation, ramping up afforestation to reduce overall land sector CO2 emissions. So those are the kind of core policies driving the IPR scenario. I think what's important to understand about IPR is how it differs from other energy and climate scenarios. Other energy and climate scenarios typically represent either a continuation of current trends. So current policy scenarios, for example, will tell you what's going to happen if nothing changes very much. And at the other end of the spectrum, there are very aggressive scenarios that try and achieve 1.5 degrees or some other climate target, and they assume that action begins today, and that action is steady and consistent from today to the target. So the key difference with IPR is, and I think you'll see how this plays out in Carbon Tracker's analysis, is that IPR recognizes that it's more likely that we'll move from one of those worlds to another. That policy and action is relatively slow currently, but that there will be a tipping point, and the shift to a dramatic reduction in greenhouse gas emissions will not be steady and consistent. It will be dramatic and disruptive, and that's really the key feature of IPR. Thank you very much.
Brilliant. Thank you very much, Eric. That was great to hear a sort of very high-level overview of the IPR program and then the forecast policy scenario in a bit more detail as well. So what I'd like to do now is pass over to Axel Dalman, Associate Analyst at Carbon Tracker, to go through the report, our new report launched yesterday, Managing Peak Oil. So Axel, over to you. Thank you. And please do fire questions through. Please do fire questions through in the Q&A at the bottom of the screen as we go through, and we'll pick those questions up after Axel's presentation. So Axel, finally, over to you. Thank you.
Excellent. Thanks very much, Mike. So as Mike said, I'm going to run through this presentation here. We'll take about 15 to 20 minutes, and then we'll have hopefully plenty of time for questions afterwards. Now, just to segue away from what Eric just talked about, and I'll repeat some of the points that he made, but really what we're trying to do in this report is to bring the FPS scenario into the context of the oil industry and to see what does this sort of uneven demand curve mean in terms of managing stranded asset risk, which is what we tend to focus on at Carbon Tracker. So let's see if I can move this along. So to summarize the report just briefly before we start, the key sort of context that we're trying to lay out here is that if peak oil demand is yet to come, then there's a real risk that the short-term price signals that would result could prompt companies to overinvest, and especially on long cycle projects. And that's a really tricky thing. Now, if they do so and they invest too heavily in the next few years, we see through our modeling that they could waste at least $500 billion this decade as oil demand and oil prices fall later in the decade after this policy response has occurred. Now, as a contrast to that, we explore an alternative managed approach where we focus on sanctioning more short cycle production in the next few years to really manage this uneven demand shape. And we find that that can really, in theory at least, eliminate value destruction. Now, the caveat is that OPEC Plus may need to step in to a great degree to manage the short-term market, but we think that they both can and that it's in their interest to do so. So let's quickly move on to the context that we're finding ourselves in right now that really sort of, I think, lays the groundwork for this story. So obviously you'll be well aware that oil prices are on the rise. They probably are hitting 90 as I'm speaking right now. And the same is true for gas prices, of course. There's just sort of upward pressure on energy prices at the moment, and this is sort of boosting inflation and putting pressure on consumers. Meanwhile, the policy pledges that came out of COP26 were really not enough to meet the goals of the Paris Agreement. So Climate Action Tracker has found that based only on the policies that have been promised to 2030 by governments around the world, we can expect warming of 2.4 degrees, which is clearly not within the well below 2 degrees goal of the Paris Agreement. And so in that context, we may see that demand may not decline as fast as it needs to and as it's usually assumed in these rapid decarbonization scenarios. Now, the oil industry's reaction to this is to call for more investment into oil and gas and sort of saying that we're moving off fossil fuels too quickly and that we need to sort of scale back a bit and invest more in fossil fuels to mitigate any kind of further inflation pressures. Now, none of this really seems to fit with the idea that demand is on a rapid, immediate downward line, sort of curve. And so that really raises the question, have we passed peak oil demand yet, or is it still to come? And that's really important in terms of planning for the industry, in terms of what kind of assets that they sanction, and in terms of mitigating risk. Now, so just to sort of reiterate what Eric has already talked about earlier here, the key distinction here between the forecast policy scenario, which is what we're using in this report to model financial risk for oil companies. The key difference between that and the sort of other fast decarbonization scenarios, for example, those from the IEA, the International Energy Agency, is the shape of it. So the IEA's scenarios, like the Sustainable Development Scenario, you can see on this chart here, the light blue line, or the net zero emission scenario, their 1.5 degree scenario in the green line, they tend to take quite a linear view. So demand kind of falls immediately from today and then on a largely straight line down to net zero. Whereas the FPS sees a much more uneven curve with demand increasing quite strongly to the mid 2020s and then seeing a sharp decline after that. Now, for the industry, this is in some ways much trickier and riskier than a linear decline. If you have a linear decline, then you're sort of staring down the barrel of immediate wind down, which in itself is, of course, extremely complicated and challenging, but it's more simple in its logic, perhaps. Whereas if you have a split like the one we're seeing here with the FPS, and we can split it into two sort of separate demand periods, really. The first one is where demand is rising in the next few years and plateauing. And then the second one is after the sort of policy response or after that kicks in, where demand starts to really collapse. And that's much trickier to plan for, particularly because your conventional oil fields tend to have quite long payback periods and take a long time to develop and to peak production. And so it's really tricky to get that timing right to supply the market in the short term when prices may be going up and when there's really demand for extra production without then being locked into additional oversupply and with low prices over the long term. So the question is, how can the industry then manage this? And so what we do in this report is that we look at two sort of different ways forward. One is quite a risky, if you will, business as usual approach that really follows current price signals. And that one destroys quite a lot of value as a result. And the other one is a sort of managed approach where you try to mitigate this risk and try to reduce long-term oversupply. So let's start with the high investment scenario, the sort of nightmare scenario, if you will. This is one where the industry, as I said, follows sort of current price signals and starts investing quite heavily as a response to rising prices and a perception of continually rising demand. So what we do in this case is that we assume that companies sanction new projects. So we're assuming that projects that have already been sanctioned will produce over the course of their natural lives. But for new projects over the next 5 years, we assume that these are sanctioned up to $60 per barrel break even at a 10% IRR, regardless of their timing, right? So regardless of whether they start to produce their oil before the policy response in the mid 2020s or after. Now, what this does is that in the short term, yes, it does meet the heightened demand that we see with the sort of rising demand. It does meet that on average, at least. But because it results in so many long cycle projects being sanctioned, you also end up with this significant oversupply over the long term. And you can see this in the chart that we're looking at here. You can see the supply in the light blue from post-FID fields. And then in the darker blue, you see the additional supply that we're sanctioning here with the $60 sanctioning price. And you can see around 2030, there's a massive bulge of production. And that's really when these big conventional projects are kicking in and really peaking production. And that's clearly well past the peak demand. And so the problem is that these projects are now producing most of their cash flows in a time when demand is falling, and as a result, prices are falling. And so they're likely to not earn their initially promised rate of return. And so this is obviously this oversupply we assume will reduce prices, and so will exacerbate value destruction. What we have assumed here is that in this case, where there's a lot of overinvestment and a lot of oversupply over the long term, it results in a long-term oil price of an average of $40 per barrel. And we gave several reasons in the report why we picked this particular number. So I encourage you to look in the report for that. At that price, we see some $500 billion of Capex that is wasted this decade. And what do we mean by wasted? It's the Capex that is committed to a project which doesn't earn a 10% IRR. And a 10% IRR is a pretty conservative level to pick. Really, the cost of capital for oil fields is really only going up and has been going up for several years. And so this is really a conservative assumption. Now, if there's a risk to the downside here, because if you look at the marginal cost of production today for oil, it's closer to $25 a barrel at a 10% IRR. And so 40 is, in a sense, generous. So the downside risk here is at $30 long term, the amount of wasted Capex would double. There's a massive downside risk in that sense. Now, to contrast this slightly nightmare scenario, we explore another one that sort of tries to be more tailored to this odd shape of the FPS demand curve. And we call that the managed case. And the idea, the goal here is to reduce the long cycle supply and by extension, the long-term oversupply in the market. And so achieve higher oil prices and better returns for these companies. So what we do in this case is that for long cycle oil, and this is mainly conventional projects, we sanction projects up to a $40 break-even price, again at a 10% IRR. Now, this in itself creates quite a substantial supply gap in the short term because, as we've seen, supply rises, and so going completely conservative might exacerbate price increases and create some strains on the market. So to fill this supply gap without then over the long term oversupplying the market, we assume that shale goes ahead at a higher price. We assume $50 per barrel in this case, $50 break even. And so what this does is it really drastically cuts the oversupply in the second demand period, so after 2026, after the sort of the peak demand happens. And you can see that in the chart here. So on the left-hand side, we have the same chart that we saw a couple of slides ago, just being put next side to side with the managed case one. And in the managed case, you can see that bulge, that pesky bulge that we had previously, has now been quite significantly reduced. Now, the price, if you will, is that in the short term, we're still left with somewhat of a supply gap. We're seeing on average 2 million barrels per day. And that's sort of on the right-hand chart here to the left of the dashed line, you see there's a gap between the demand and the FPS and what new projects can supply. So that obviously needs to be remedied in order to keep the market balanced and to avoid rampant price increases. I think the obvious answer really is that OPEC Plus can and should step up more with spare capacity to manage this. And you know, despite recent unwinding of spare capacity, there's still, according to different estimates, significant spare capacity left. Now, of course, OPEC wouldn't want to, and perhaps nor should they, exhaust all their spare capacity, because of course market stability relies on having that added slack in case of supply outages. But there's substantial spare capacity left, and that we think that could be used to manage this short-term gap in turn without creating this mass oversupply that we saw in the high investment case. Now, we also think that this is in OPEC's long-term interest, aside from anything else. Sitting back and letting prices rush over $100 a barrel is very likely to draw in additional shale. And we've been here before, pre-2015, when this happened, with the end result that the big OPEC producers ended up trying to flush out the market with extremely low prices. And that was fiscally very, very painful for OPEC. And so that's not a situation that they would want, we think, to put themselves back in. And in addition to that, the demand destruction that would result from higher prices is now much more of a real threat than it was 10 years ago in the last commodity supercycle. You know, 10 years ago, EV switching was a threat on the horizon, but today it's incredibly real, that threat to producers, and a very real one, and can easily happen if prices go up too high for too long. And so I think that is another reason why OPEC should be interested in keeping prices at a more reasonable level, perhaps somewhere around where they are right now. Now, aside from that, we think other sources could mitigate the gap too. So it wouldn't necessarily have to fall entirely on OPEC's shoulders. So for example, investment in offsetting natural declines from existing fields is something that could mitigate the supply gap and reduce the burden on OPEC. So the result here is in the managed case, by reducing the long-term oversupply, we think it's easier to maintain a higher price on average, which in turn means that less value is destroyed. More projects can earn their promised return. What we see is that regardless of what long-term price assumption you choose, the managed case has less wasted capex overall. And certainly in our sort of central case, our benchmark case of $50 per barrel long-term, wasted capex would be eliminated, and all the new projects that are sanctioned in the next 5 years would earn their 10% return. Now, you might look at this chart and say, well, look, at $50 per barrel, if you look at these two rightmost columns, probably can't see my mouse, but look at the two rightmost columns in this chart here. We're looking at a $50 long-term price at these two different supply cases. You might look at this and say, well, there's significant missed opportunity here by not investing more in capturing that additional profit opportunity. So why wouldn't I, as a producer, do that? And the answer is that this is really, from our perspective, a mirage. This $50 per barrel long-term price, because investing so heavily and oversupplying the market so heavily over the long term is very likely to result in lower prices. And in fact, the risk is more tilted towards the downside, right? On the two leftmost columns, or perhaps the single leftmost column, at a $30 long-term price in the high investment case with $1 trillion of wasted capex. So that's really what producers should be focusing on. And so this is really connects to a bigger sort of theme, I think, in Carbon Tracker's thinking that, you know, in order for the industry to remain investable as the energy transition accelerates and as ESG pressures increase on the industry, in order for them to remain investable, they really have to focus much more, place more emphasis on risk mitigation than on pure cash flow maximization. And that's really what the managed case is trying to enable. So in sum, just to bring us back to what we talked about, if peak oil demand is still on the horizon, as the forecast policy scenario assumes, then price signals could prompt companies to overinvest, particularly into long cycle projects. Now, if they do so, that could waste significant amounts of capital and destroy value for shareholders as oil demand and prices fall later this decade after oil demand has peaked, which does happen in the middle of the decade in the FPS. And to contrast this, we explore a managed approach, which is focused on risk mitigation and in particular focused on enabling more shale oil in the short term to avoid that very long-term oversupply and which could in theory eliminate value destruction. But in order for this to be workable, OPEC needs to step in to manage the market in the short term. And we think that they can and are willing to do that. Thanks very much.
Great, thank you, Axel. Please do send questions in through the Q&A at the bottom of the screen. We've got a few coming in already. So Axel, I'll put some of those to you right now. I think the first thing might be, Carbon Tracker has historically been quite bearish on shale, particularly for companies that have a significant share of their current production from shale. What's changed here?
Yeah, so I think the change here is that it's about how you think that the future is going to pan out. In a linear future where demand declines quickly, you end up with a much more immediate reduction in prices. And so when you compare all projects options that are available to oil companies currently, shale oil isn't necessarily the most competitive. However, in a situation where demand rises in the short term, then shale oil clearly has something to offer, right? In its granularity, in its short development times, and in its sort of ability to avoid locking in capex long term. And so I think if the key thing here is that if we believe that the FPS is happening, if that's what, as an investor, if that's what you subscribe to, then really this is perhaps the sort of outcome that you would want to see.
Great, thank you. And I suppose sort of moving on to a second question, of course, the analysis you presented just now and actually the sort of significant majority of the report we released is focused around oil. But good to hear your thoughts around some of the implications from this FPS scenario for gas. So if you could talk, so could the specific question here is, could the demand curve also be applied to gas? So yeah.
Thanks. So with gas, actually in the FPS, the demand curve is not quite as different from your typical IEA scenarios as it is for oil. So globally, gas declines in a fairly straight line in the FPS. And certainly for developed markets like Europe and North America, it's a pretty straight and steep downward decline. And so you don't get that same problem, right, with in terms of demand increasing in the short term and sort of sending these strong investment signals to companies. However, you could still argue that the narrative on gas hasn't quite moved as quickly as it has with oil. So with oil, there's a lot more, I think, understanding about what kind of the drivers of the peak will be and when that might happen. But with gas, there's still quite a lot of optimism within oil and gas companies about how drawn out the peak will be. And many of them are even the ones that have committed to being energy transition plays, like the European majors, are still very optimistic on gas demand. And so there, I think you still have a substantial risk that they misread that future as well.
Yeah, and I think, thank you, Axel. And I think it's important also to note on that when we're talking about gas here and the risk to gas and this risk of this demand destruction and lower demand than company forecasts, we're talking about that on a multi-year, this decadal time frame. Of course, right now, particularly in Europe, there is a gas price crisis, and we're seeing high gas prices, and the drivers of that are certainly different to these longer term pieces around the overall energy transition, the rise in renewables, and for gas and electric vehicles, as Axel's describing for oil, and that overall energy transition combined with so those two aspects of that, the policy side, but also the technological drivers as well. Now, sort of moving on just to add on to that, I mean, certainly if you look at the market right now, you might think that it should be all go ahead for new gas projects, right? But I think you have to think about the fundamentals, the long-term fundamentals, and look beyond the transitory effects, right? Because many of the effects that are influencing gas prices now are ultimately transitory, right? And are a combination of different transitory effects and political effects, right? Which wouldn't really be captured necessarily in modeling like this. But for a company that's looking to invest in a long-term project, they need to think about the policy drivers that are going to happen long-term, and that's really key. Okay, so we've had another question come in here, which is, what do you think the current cost of capital for oil investment is? And I think probably also worth touching on that and how that's been captured in the report, and then some of the other trends in the industry as well.
Yeah, sure. So for oil companies, in terms of what the cost of capital is for an oil company, depends on the size and the kind of player it is. But generally, it's around the 10% mark. For a major, certainly it's around 8, 9, 10%. We've seen in different sort of from different sources. For smaller companies, it may be a little bit higher. But then the question is, you can also look at that differently in terms of what do shareholders want? What do they expect if a company comes to them and says, we want to develop this new project, which is not going to repay its investment until, say 2030, and what is the risk payback that the investor wants then? And if you look at surveys that have been done of investors, and you ask them what do you want for a company to reinvest the capital in new supply rather than to hand it back to you as a shareholder, it can usually be substantially higher than the company's own cost of capital. So that can be in the upwards of 15, 20%. And certainly for complex, long cycle offshore projects, deep water offshore projects, that can be higher. So I think from that perspective, the 10% IRR that we picked here is really quite conservative, and so you might even want to pick a higher one.
Okay, thanks. And so I suppose the next question that we've got that's come in, I mean, really, what obviously with this report is aimed at an investor audience and really highlighting the risks of a non-linear transition. I mean, what are those implications for investors? But really more, we've covered some of the implications, the financial risk aspect clearly. If you could touch on some slightly broader implications, but also what are the actions that investors should take as a result of this piece of work?
So for us, the key thing, if you it depends, of course. We say investors as a group, but of course it depends on what kind of strategy you have in terms of achieving the results you want. If you're an engagement-focused investor and you're trying to get the company you're invested in to change, it's really key to challenge management on big projects that won't deliver first oil until late this decade. They would need to be very cost competitive. And in this case, it's good to get third-party estimates if possible, rather than rely on the company's own estimates, which can be rose-tinted. To challenge management on those projects, really, and to ask, is this the best use of my money, or can it be better spent? Certainly especially for a company that is planning to transition as well, like European majors. The question is, why not spend this on transition industries instead of investing in long cycle projects? So that's really important. And then certainly if you are in terms of picking your investments, rather than, there's certainly companies that might, if you think that this is going to play out, this sort of demand trajectory that we see in the FPS, if you think that's going to play out, then certainly there's companies that would benefit more from that. And shale comes to mind as an example of that. In the report, we show also within the shale segment, we show which companies are most resilient to downward price movements from our sort of central long-term price assumption, which I think is important, not just whether you're a shale company, but also whether you have competitive shale assets on your books.
And sort of a follow-up question we've had in here. I know in the report we touched on some specific company names that we think we saw as being potentially more resilient, and some of those that are less resilient from through this. Do you have any suggestions of names that investors could look at to who may benefit from this, particularly around resilience, and potentially those with the shale-focused companies as well?
Yeah, absolutely. So I don't have those the ranking of, say, for the shale companies in particular. I don't have that ranking at the top of my head. Certainly, if you look in the report, there's one of the graphics that shows that, and I would really encourage people to go into the report and look at that. It's sort of in the under the managed case section of the report is where you'll find that, and that sort of ranks them as well. On the flip side, we also show some projects that are long cycle, so I would not deliver oil for many more years, and that are also relatively high cost. We also list those in the report. So if you see a company in there that you're invested in, then that could be a prompt to engage more forcefully.
Yeah, so I think it's as Axel says, I think it's really important that that investors can engage with their investee companies on specific projects and really question, why is this project viable given under a range of different scenarios. And we should stress that this is a piece of modeling around a specific scenario, the forecast policy scenario. It's a 1.8 degrees C scenario. But the reason we think it's instructive to look at this scenario, and we were asked to do so, is that in contrast to the linear decline scenarios of the International Energy Agency, some will see, and particularly with existing current high prices and sort of demand surge, a short-term growth and then a rapid peak and then a rapid deceleration. And so it's that long cycle piece that's really important, that investors question companies on why long cycle projects, if they're developed now, point forward, why and how companies feel that they are competitive in the long term. And I think there's also a piece here around exploration. I mean, a number of the projects we highlighted there are large. Some of the largest projects that we highlighted, offshore Brazil, for example, where of course there's still exploration globally in deep water offshore. And again, deep water offshore, large, long cycle projects. Now, the question investors must ask is, are these really viable long term in a world as the energy transition accelerates for a number of different reasons? Now, Axel, I think it's probably
Oh, sorry. I wanted to add a comment to that.
Sure.
But, yeah. So it's probably worth recognizing as well that it's not always easy for investors to make these calls and to engage, because the information isn't always available, right? Because companies don't always disclose enough for investors to make these assessments. And that's one of the big problems that we've also highlighted in other work streams at Carbon Tracker, like financial disclosure. And so we're really moving quickly with this. A few years ago, these kinds of engaging that forcefully with a company about specific projects, I think would have been far less common. And so it's interesting to see how quickly this is moving, and hopefully more companies can get on board with these sort of more expanded financial disclosures that we also are trying to push at Carbon Tracker, which I think would help them into making these assessments about whether projects are viable or whether they would be at risk of written down, and so on and so forth.
Great. So I think we're coming up right on time there. So what I'd like to do is really thank Axel for ultimately for really being the driving force behind this report, and for other reports Axel has certainly done the past. And really thank Axel for that, for the presentation today, and also our thanks also to Eric Ling from Vivid for the introduction from the IPR program as well. I'd also like to thank the events team, Evgenia and Helena, for facilitating the session today as well. So what I'll leave you. So we'll leave the session there, and we look forward to you joining us for future sessions. Thank you very much.
Thank you.